This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Pushing higher, the Dow extends its record gains, but it may be earnings that decide which way stocks go next.
Paying for the wall. The White House says a new border tax is one way to fund the project, and it could be aimed at all Mexican imports.
Training your replacement. It's not something anyone wants to go through, but it's happening at an American university. Those stories and more tonight on Nightly Business Report for Thursday, January 26th.
Good evening, everyone, and welcome. The Dow pushed further into record territory today, but to keep stock prices high or moving even higher, it will almost surely take rising corporate earnings. And that's where we begin tonight with a number of late-day profit reports. First up, Alphabet. Earnings at the parent of Google grew from a year ago, but they were not as strong as analysts had hoped. The company earned $9.36 a share. That was below expectations of $9.64. Revenue up 22% to more than $26 billion as advertisers spent more to reach users. Shares, however, were down initially in after-hours trading, as you see on that graph. And our Deirdre Bosa has more on Alphabet's quarter. Hi, Deirdre.
Hey guys, well, that's right. You ran through the numbers, but here's what it comes down to. Ad dollars are still Alphabet's bread and butter, but perhaps a little bit less so as the company, transitions for a modern business era. Over the last quarter, Google's other revenue, which includes things like its cloud business, as well as hardware, as well as Google Play, its operating systems, jumped more than 62%. The takeaway is that Google continues to make a lot of money from online advertising, but it's also investing in future businesses as well. On the earnings call, Google CEO said that they're now focusing away from mobile into artificial intelligence. That is the focus. Back over to you guys.
Deirdre reporting from a beautiful San Francisco. Thanks again.
Meantime, Dow component Microsoft reported a rise in quarterly profit driven by demand for its cloud business. The world's largest software company earned 83 cents a share, 4 cents better than estimates. Revenue grew by a little bit more than 1%. Shares were volatile in after-hours trading. Josh Lipton has the one key takeaway from Microsoft's quarter.
$14 billion. That was a big number in Microsoft's latest report, and that is the company's annualized revenue now for its commercial cloud business, and that's a jump from the last time it reported results. Kirk Materne, an analyst at Evercore ISI, says that number shows that the commercial cloud business is showing strong growth. He also points to its profitability, with gross margins for the business of 48%. Now, that is a slight deceleration from the previous quarter when they came in at 49%, and a bit below at least what some analysts had expected. Still, Materne says this report shows that Microsoft's pivot back to an earnings growth story remains on track. For Nightly Business Report, I'm Josh Lipton, San Francisco.
A stabilizing PC market helped Intel's quarter. The world's largest chip maker also saw an increase in demand for its data center services. Earnings came in better than expected, and the Dow component reported a 9% rise in revenue to boot. Shares dipped and then rose in extended hours trading.
It was a weak quarter for Dow component Caterpillar. That company trimmed its sales outlook for 2017, potentially extending a 4-year decline. The heavy equipment maker said one reason for the soft outlook was because of the strengthening dollar. Shares dropped almost 1%. Morgan Brennan has more on Caterpillar's quarter.
Contrary to hopes, it wasn't an earth-moving quarter for Caterpillar. The maker of mining and construction equipment said sales are poised to fall for the 5th straight year, as sluggish global growth and falling commodities prices have depressed demand for machinery. In his first earnings call with investors, new CEO Jim Umpleby noted the economic environment is still challenging and that President Trump's prospective policy changes won't boost business until 2018.
We continue to closely manage costs. We're also preserving capacity for a potential increase in business whenever that comes. There are positive signs in many of our markets, but we are not anticipating an impact in 2017.
But with commodity prices making a comeback, Wall Street's raring for a turnaround. And with Trump ordering a border wall, green-lighting pipeline projects, and promising a $1 trillion infrastructure overhaul, the stock has soared. Shares of CAT posted the biggest gains of the Dow last year. And the continued increase has helped catapult the industrial average above 20,000 this week. Analysts say today's results show the hard-hit machinery market is stabilizing. but there's still a long way to go.
Industrial America is going to get better, it's going to get stronger, and the outlook is far better. It just doesn't happen overnight. So the stock market's been very aggressive in driving up stocks that will probably benefit from policy changes, and clearly Caterpillar is a bellwether. It just will take time to happen. So right now, investors clearly are paying for improvement in 2018 to 20, not what's going to happen in 2017.
In other words, shares of Caterpillar may have gotten ahead of themselves. And while proposed policy changes could benefit the company longer term, the Trump rally has also spurred strength in the dollar. And that could be a headwind, pressuring commodity prices and export sales. For Nightly Business Report, I'm Morgan Brennan.
So far, about 146 companies in the S&P 500 have reported quarterly results with profits and revenue on track to reach their highest level in 8 quarters. But a number of companies are also warning about future earnings growth. So how will earnings affect the market? Brad McMillan is Chief Investment Officer at Commonwealth Financial Network, and he joins us now. Mr. McMillan, Brad, good to have you with us. So how are we doing? How are we doing, and are earnings good enough to support stock prices where they are today at records?
We're doing really well. We're actually seeing earnings growth. We're seeing faster earnings growth as the quarter goes on, and there's good reason to believe it'll be faster yet.
And what is behind that? Because a number of companies, I think, kind of softened their guidance, perhaps worried about the strengthening U.S. dollar or perhaps what the election might do to the economy. And some of that has not played out very well.
I think part of this is the classic expectations management game. What you have is the market is pricing in a lot of good news, as you just said, for Caterpillar, and executives are trying to walk that back to keep the expectations reasonable. They want it to be good, but it may not be as good as people expect, so they're trying to manage that.
So what are the standout sectors, Brad, and are they worth my money right now?
Well, I think financials are the one thing that everybody's talking about, and that's absolutely justified. But when everybody knows it, how much more surprise is there? The one thing I'm looking at is consumer discretionary. I think that's the one area that could really do much better than people think.
And you also like energy.
I do, but that's more of a longer term play simply because companies are still fighting to accommodate it, but the turnaround is almost done and we're just about there.
Let's cast out over the course of this whole year. We're sort of tracking for 6% earnings growth in the recently closed quarter. What are you looking for in 2017? And might 2018 be even better if some of the lower corporate tax rates kick in by then?
I think 2017 is likely to be better. We're probably looking at earnings growth at least in the 10 to 15% range, maybe better. I think the earnings growth, the corporate tax is going to be a big part of that. That could be the upside surprise that really helps matters along even further.
Now, you also say utilities and industrials very quickly might be the laggards in this. Why?
I think they've gotten ahead of themselves. I think there's been a lot of expectations built in. And as we shift to more of a growth type of market, they're simply not going to show the growth that the market's going to want to see.
All right, Brad, thanks very much. Brad McMillan with Commonwealth Financial Network.
Thank you.
The Dow continues its rise one day after hitting 20,000 as investors size up the latest rounds of earnings reports. Consumer stocks climbed while healthcare and utilities lagged today. The blue chip index added 32 points to 20,100. The Nasdaq and the S&P 500 were both off about 1 point.
New home sales dropped sharply in December. The Commerce Department reports that purchases of newly built single-family houses fell more than 10% last month. That was the steepest one-month decline since February. The decrease may be an indication that rising prices are keeping some potential buyers out of the housing market. New home sales make up a very small percentage of the overall housing market.
The number of Americans filing for first-time unemployment benefits rose last week. According to the Labor Department, initial jobless claims, which is a proxy for layoffs across the country, increased by 22,000 to 259,000. Despite the increase, though, the overall level remains near historic lows.
Tomorrow, investors will get the first look at economic growth in the fourth quarter of last year. President Trump said he wants to get the economy growing a lot more than it is now, but he may have his work cut out for him. Steve Leisman explains.
Does President Donald Trump have the secret sauce to make the economy boom? CNBC took a detailed look at the times the economy has grown more than 3% since 1990 and found that Trump has the ingredients about half right. First thing, the economy's only grown more than 3% about a third of the time since 1990, so it's pretty rare. Trump's promised 4%, even rarer. The analysis shows that boom-like growth requires an economy firing on all cylinders. Consumer spending, which accounts for 65% of the economy, needs to support annual gains of 3.5% or better. But that's not even enough. Productivity has to surge. It's averaged just over 1% annually since 2010. It averages 2.7% during the boom years. But that's also not enough. Business spending and exports have to play a vital role in getting the best growth. Now, these are two areas where Trump has promised to focus with tax cuts and deregulation.
I think a lot of what he's talking about doing it speaks exactly to what the economy needs. I think certainly corporate tax reform is going to be very important to getting business investment cranked off. I think businesses have been kind of sitting and waiting to see.
But Trump's plans may be weaker in other areas. The analysis shows government spending and imports also surge when the economy booms, and Trump's policies may depress these areas, possibly limiting growth.
Obviously, there are other aspects that we have to watch out for. Let's see if he has success on the trade front. That could be very good or it could be very bad, depending on how other countries respond to what I would call a more aggressive posture to trade negotiations.
For investors, a correct bet on strong growth can be lucrative. During the 9 years when the economy grew north of 3%, stocks returned an average of 16%. So there's reason to hope Trump gets the secret sauce right. For Nightly Business Report, I'm Steve Leisman.
Still ahead, why the rift between the U.S. and its southern neighbor seems to be deepening.
Ford Motor took a $200 million charge connected to closing its plant in Mexico. The cancellation contributed to a quarterly net loss, first since 2009. But if you exclude that charge, Ford reported a profit that matched analyst estimates. Ford's CEO met twice this week with President Trump, who praised Ford for abandoning its factory in Mexico.
I think we have the appropriate amount of assembly plants here in the U.S. Of course, we're always looking to grow our business and use the assets that we have here even more. And, we had a very positive meeting with the president. I mean, think about it. In the president's literally first couple of days in office, he has said that he's going to focus on the economy, and both manufacturing and automotive have been some of his first meetings. So I view that as very, very positive for the industry and the economy going forward.
Shares of Ford fell about 3% today.
President Trump's planned meeting with the president of Mexico has been canceled as tensions rise between the two countries.
The president of Mexico and myself have agreed to cancel our planned meeting scheduled for next week. Unless Mexico is going to treat the United States fairly, with respect, such a meeting would be fruitless, and I want to go a different route. We have no choice.
The rift follows President Trump's signing of an executive order to construct a border wall. And the White House press secretary says a new, perhaps 20% tax on all imports from Mexico would be one way to pay for the wall, but that the financing is a work in progress.
If you tax that 50%, $50 billion at 20% of imports, which is, by the way, a practice that 160 other countries do. Right now, our country's policy is to tax exports and let imports flow freely in, which is ridiculous. But by doing it that way, we can do $10 billion a year and easily pay for the wall just through that mechanism alone.
The president and leaders from the Republican Party are at a retreat in Philadelphia, and that is where John Harwood is as well tonight. So, John, let's start with the canceled meeting. How damaging might this be to U.S.-Mexico relations?
Well, nobody wants a trade war. You heard the president in the bite you just played signaling that, or trying to cast it as a mutual decision, but this is clearly something that it's become a point of pride for Mexico to resist his statement that Mexico is going to pay for the wall. And you just don't know where that's going to lead and what effect it might have on the U.S. economy. Mexico is a major trading partner of the United States, and a key part of the supply chain for American corporations. And we're going to have to watch how this develops, whether it gets patched over, and, of course, what the effects are going to be on the potential renegotiation of NAFTA, which President Trump says he wants to do.
Let's talk about this import tax, because it's hard to get my head around at the very least, John. Who actually pays it? Is it the Mexican company that is sending the goods into this country, or is it the American consumer who's going to pay higher prices because there's a tax built in to the product from Mexico that they buy?
According to economic advisors that I talked to today, Tyler, from both Republican and Democratic administrations, it would be substantially the American consumer who would pay that fee. Nevertheless, I did talk to a Republican member of Congress late in the day who said he thought the votes would be there if, in fact, that's what Mr. Trump wants to do. The House Republicans are eager to cast this as consistent with their border adjustment tax. But there's a complication there. There's a question over whether the World Trade Organization would approve this border adjustment tax as compliant with our trade commitments, and casting it as a means of extracting money from Mexico would complicate that case.
Yeah. What, if anything, was said today about tax reform and perhaps the move to repeal and replace Obamacare?
Well, these are really key subjects of division within the Republican caucus, Sue. They've got to agree on, is there going to be a full replacement for Obamacare? How quickly is that going to come? Are we going to have a reform of the individual tax code as well as the corporate code, or only corporate? Are either of these things going to be deficit neutral? Are they going to expand the deficit? I talked to a Republican member of Congress afterwards who said even in the closed-door meeting, not a lot of new ground, not a lot of details. So Republican lawmakers who were expecting clues from the president today did not get them.
On that note, John Harwood in Philadelphia. John, thank you as always.
Well, Johnson & Johnson plans to buy a Swiss biotech company for $30 billion, and that is where we begin tonight's Market Focus. The healthcare giant said it will acquire Actelion in a deal that will add to J&J's rare disease drug portfolio and potentially strengthen sales. As part of the merger, Actelion will spin off its research and development unit. J&J shares were off a fraction on the session at $111.84. Well, the Wall Street Journal says that the telecom giant Verizon approached cable provider Charter Communications about a potential tie-up, but CNBC, citing sources, said the two companies are not in significant talks. Verizon and Charter have not commented on the news. Charter shares up 7% at $333.15. Verizon's down about 1% at $49.12. And Mattel shares continued to dive after the toy maker said late yesterday that a difficult holiday season caused results to miss estimates. Today, MKM Partners downgraded Mattel stock to neutral and cut its price target to $27, down from $36. The firm cited a slowing turnaround, rising input costs, and the company's unfavorable product mix. Mattel shares plunged 17% to $25.99. Meantime, Southwest Airlines said higher fuel and labor costs caused its profit to fall, but results were still good enough to beat expectations. The company also posted better than expected sales, and CEO Gary Kelly said several factors contributed there.
We had strong traffic, a strong load factor, and then also a strengthening of fares, especially in December. So the combination was an improvement of about a percentage point in revenues, so it was very meaningful.
Shares rose 9% to $53.92.
Northrop Grumman said higher volumes of its F-35 fighter jets and other aircraft helped sales rise and beat estimates. The defense contractor also posted better than expected profit, but gave weak earnings guidance for the year. The shares fell more than 1.5% to $226.96. An increase in home sales and higher average selling prices helped Pulte Group top expectations. The home builder also said it expects to see continued growth despite rising interest rates. The shares were up more than 3% to $21.18. And Whirlpool posted flat quarterly profit as the maker of home appliances said the worse than expected results were hurt by currency headwinds, particularly a falling British pound, as well as weakness in overseas markets. But overall, sales did grow and came in above expectations. Whirlpool shares fell more than 8%, though, to finish out at $173.94. Starbucks saw same-store sales rise both domestically and globally in its latest quarter, but both results fell short of analysts' expectations. The coffee chain also missed revenue estimates, while its earnings were pretty much in line. Shares initially fell after hours and ended the regular session down a fraction to 58.46.
Coming up, the growing backlash at a California university over its decision to offshore jobs.
Here's a look at what to watch for tomorrow. Dow component Chevron reports earnings. Investors will be looking to see if the company is ramping up major projects and what that means for production growth. And the first read on fourth quarter economic growth is due out, and President Trump welcomes his first foreign leader to the White House, UK Prime Minister Theresa May. A bilateral trade deal is expected to top the agenda. And that's what to watch for on Friday.
The Securities and Exchange Commission finds Citigroup $18 million for overbilling investment advisory clients. The agency says the bank overcharged at least 60,000 customers over a 15-year period. Citi has agreed to improve its fee billing and books and records practices. Those affected have been reimbursed.
Investors pulled the most cash from U.S. stock funds since the election. According to the investment company Institute, withdrawals totaled more than $3.5 billion during the latest week. That's the largest outflow since early November. Meantime, taxable bond funds added more than $3.5 billion. That's its seventh straight week of gains.
Imagine your high-paying job is being outsourced to a lower-paying country. Now imagine you have to train your replacement. It's something the president has railed against and something that's currently happening at a well-known American university. Aditi Roy has our story from San Francisco.
In just a few weeks, Robert Harrison, a 57-year-old senior telecom engineer at UCSF, will be out of a job. He will be replaced by an offshore worker.
It's been a very demoralizing position to be in, to know that we're coming to work for a company that's going to ship our jobs out to people in India.
Harrison, who's worked at the university for 2.5 years, is one of 49 career employees and 30 contractors who are being replaced by offshore workers. The UC system signed a contract with HCL, an Indian outsourcing company, to fill the positions. The employees spoke out this morning during a regularly scheduled UC Board of Regents meeting.
It is an outright neglect that makes it clear there's a mix of priorities here.
The cuts are part of a cost-cutting program that UC officials say will save UCSF $30 million over 5 years. It's an issue that has made national headlines. It once again brings to the spotlight the H-1B visa program, an issue President Trump has spoken out about and the need to reform it. The program brings 85,000 workers to the U.S. It's designed to attract highly skilled foreign workers for jobs there aren't enough qualified American workers to fill. But critics of the program argued since it doesn't require firms to recruit American workers first, it makes it easier for them to replace those workers with cheaper foreign counterparts. UC officials say while several workers on H-1B visas were brought in to help with the transition right after the cuts were announced, officials say they have since not used H-1B workers and have no plans to do so. The LA Times says the program has been co-opted by outsourcing firms that use the visas to import workers, mostly from India, to replace Americans in middle-level IT jobs. And in fact, many outsourcing firms, including HCL, grab about half of all the H-1Bs issued every year. Adding more volatility to the politically charged issue, the cuts were approved by UC President Janet Napolitano, the former Secretary of the Department of Homeland Security. But under a loophole in the visa law, displaced UCSF tech workers like Kurt Ho are training their replacements.
It's very uncomfortable. We're essentially training this person to replace us, and they're going to take over our jobs.
It's just the latest high-profile case of American workers training their offshore replacements. In 2015, Disney reportedly laid off workers and required some of them to train their replacements. And PG&E just announced it is cutting 180 jobs, and the company's offshoring 70 of those jobs. 110 displaced workers have also been asked to train their replacements. Meanwhile, workers like Harrison are speaking out and worrying.
What am I going to do? That's my biggest concern. I lay awake at night wondering, what the heck am I going to do?
The workers' last day is February 28th. UC officials say the other 9 UC campuses also have the option of using the same outsourcing firm to cut costs. However, at this point, none of the other campuses have exercised that option. For Nightly Business Report, Aditi Roy, San Francisco.
Something to keep our eye on. We'll be following that
Absolutely.
story. All right, on that note, that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll see you back here tomorrow night.